and you'll note that we have muted all the attendees. This is to ensure that everyone can hear us clearly. If you look at the bottom of your screen, you'll see the Zoom settings. If you have a question during the seminar, please click on the Q&A button and then we'll write them in there and then we'll go through them at the end. So today we are doing cash flow management and we have a nice thought of the day. Rebecca, if we can, there we go. The fact is that one of the earliest lessons I learned in business was that balance sheets and income statements are fiction. Cash flow is reality. Does this quote resonate with you? How many times has your accountant told you that you have had a great year? You made a solid profit, and yet you don't have the cash in the bank to show it. This session today is about challenging you to become much more aware of the cash flow cycles in your business and to do some things differently in your business so that you improve your cash flow. Keeping the cash flowing, the 5 principles. Throughout this session, I'll be repeating these principles. Cash is the lifeblood of any business. Without cash, your business cannot survive. In fact, very profitable businesses can fail because of poor cash flow. When a business is growing fast, often in startup mode, it needs working capital to fund that growth. That's why it's called working capital, because the spare capital has to work hard, because the business is having to pay for stock, fund payroll costs and overheads, and buy new assets before it gets to bank the cash from selling its goods and services. The fact that business is making a profit on paper and yet is cash tight is precisely why every business owner needs to understand their cash flow drivers. These are the business processes that affect your cash flow. Processes like, how do you order stock and pay for it? How will you bill for your services? And how you make sure you get paid by your customers, just to name a few. Many of you here today would have been asked to complete a cash flow forecast for the bank, often because your overdraft is blowing out. When that happens, preparing a cash flow forecast is vital. In fact, every business deserves a cash flow forecast. This should be one of the things that you do after you've completed your annual one-page business plan every year. It's simply best practice in business. And yet, simply preparing a cash flow forecast every time the bank asks for one is not going to fix the underlying causes of poor cash flow. Borrowing more money from the bank is not a long-term solution, and it costs you interest. By looking for the underlying causes of your poor cash flow and making some changes to your processes, you are not just treating the symptoms, you're treating the cause. This won't just help our cash flow, it will build a much better and more valuable business. It will also reduce your frustration and stress levels enormously, and we all want that. Right, now we'll go through the agenda, and here's what we're going to cover in this session. Hopefully, you come out of this session with 3 actions that you can put into place in your business. The biggest problem in business is FTI. And what do you think FTI means? It's failure to implement. If you don't write your actions down, you won't remember them. We want you to get the maximum value from this session. So in this session, we're going to help you understand the difference between profit and cash, because reading your monthly P&L and seeing your bottom line profit is one thing, but understanding why you don't have that profit sitting in your bank account is entirely another. Then we'll look at the working capital cycle so that you understand why working capital is so important for your business, and even more so when your business is growing. We'll then look at the cash conversion cycle, and you'll do a quick exercise to work out your cash conversion cycle in days. How many days it takes to convert the goods and services you produce into cash. Your plan for cash flow improvement will involve committing to preparing a cash flow forecast and setting some goals to improve your cash flow. We're then going to look at the 7 biggest causes for poor cash flow, and together we'll brainstorm some ways we can improve them. Profit versus cash. Who in this webinar reads their financial statements from their accountant? Now be honest, it's okay to admit that you don't read them. Rebecca and I expect that. So, if that's the case, who understands the difference between profit and cash? Profit is the money left once expenses are paid. Some people think business owners can take profit to the bank, if only. Profit is used to pay for new equipment or materials needed for the business to grow. And unless you buy a politician or two, you pay taxes out of the profits as well. Only after paying for growth and taxes do the owners get to take any money home. So a profitable business can go out of business because it's starved of cash. A business making a loss can survive because it has access to funds from the investors or financiers. Profit equals the total sales value less the cost of the stock and other expenses, which all exclude GST. Whereas cash equals all the cash inflows less all the cash outflows, including GST. So you'll see this little box down below shows the difference of some of the expenses that we have and money that goes in and out, and whether it affects the profit of the business and whether it affects your cash flow. So when you make a GST payment, that doesn't affect your profit, but it does affect your bank balance. Loan repayments, again, don't affect your profit, but they do affect your bank balance. Interest on loans actually affects both. And cash spent on assets, again, doesn't affect your profit, but it does affect your bank balance. And finally, depreciation, the lovely calculation us accountants do, that affects your profit, but it doesn't have any effect on your cash. When the calculation of profit does not show how much of that profit needs to be retained to allow the business to grow. Available cash, on the other hand, is affected by how long our customers take to pay us, how long it takes us to pay our suppliers, whether we're growing as a business, what we're drawing out of the business in personal spending, our loan repayments, our income tax payments, and new assets we need to buy for the business. The link between profit and cash is simply timing. We call this the working capital cycle. For example, if you're a service provider, your working capital cycle is this. You sell services to a customer. Once you've invoiced your customer, that amount increases your accounts receivable total. That is what your customers owe you. But that isn't money in the bank yet. It's sitting in your accounts receivable ledger until you get paid, and then that is the cycle. Whereas if you're a manufacturer, the cycle looks like this. To make the goods, you purchase stock and materials. You may have to pay some suppliers immediately. Others may allow you to pay on the 20th of the following month. You manufacture your goods, and at any point in time, you'll carry some working stock or work in progress or stock of unfinished goods. Once you receive an order for goods from a customer, you make a sale. You invoice that customer, and the amount of the invoice is now in your accounts receivable ledger. You now have to wait for your customer to pay you. So you can see that it takes some time, depending on your type of business, to convert whatever it is you make or what service you provide into cash. To understand the cash effect of this on your business, you need to calculate your own cash conversion cycle. Let me show you what I mean by that. So this is a wholesaler, and the wholesaler buys stock from the supplier and has until the 20th of the following month to pay for that stock, which is an average of 35 days. So on average, he must pay his suppliers 35 days after buying the stock. He isn't able to sell the stock the moment it comes into the warehouse. Some stock sells quickly, other stock takes longer, and eventually some stock has to be discounted to get it to move at all. On average, he holds on to his stock for 65 days. When he sells the stock, he provides credit terms to his customers, but a number of his customers don't observe the credit terms, as we all know. He's worked out that on average it takes 45 days for customers to pay him. So now we can calculate his cash conversion cycle. The 65 days, which is the average stock holding, plus the 45 days to get paid by the customer, less the 35 days credit his suppliers give him, means it takes 75 days to convert the inputs into cash. Hopefully it's now obvious to you that the shorter the cash conversion cycle, the better the liquidity in your business. If you're a manufacturer, wholesaler or retailer, to calculate your cycle, you'll need to know your average supplier payment terms in days, the average days that you hold stock for, and the average debtor days. If you're a service provider, on the other hand, you need the average supplier days, the average work in progress days, and the average debtor days. So we don't confuse you, let's go through a worked example. In this example, we have the manufacturer has sales of 1.5 million, cost of goods sold of 955,000. His overheads are 220,000. His accounts receivable is 210,000. Inventory holds on in stock is 160,000, and his accounts payable is 95. So by working out the cash cycle, it's worked out that it's 76 days from when he first buys the stuff to when he actually gets paid the money in his bank. By focusing on reducing the debtor days by just 9 days and the amount of days he holds his inventory by 6, the business has been able to release 52,000 more of cash. That's 52,000 more that he can use to pay off his overdraft or have in his bank account, however you want to look at it. These are the sorts of numbers that we can help you run through to see the impacts on your business of shortening your cash cycle. But you can't just release this cash without doing something differently. To achieve this sort of improvement, you need to have a plan. And here are the 4 actions you need to take to improve cash flow. Number 1, prepare a cash flow forecast and make this part of your annual business planning. How many of you prepare a month-by-month forecast every year? This is what our most successful clients do. Who finds the thought of doing a cash flow forecast scary? That's okay if you do. The first time you prepare one, it can be confronting. You're talking about money, facing cash flow challenges. That's important, they won't go away. When you have your forecast in place, however, there's a sense of peace and relief that comes with that. You can share your cash flow forecast with the bank to help build better communication and stronger relationship. You'll be able to predict those months when there is more cash going out than coming in, for example, when it's tax time. You'll also know in advance about any seasonal fluctuations in your business. You won't be flying blind anymore on the issue of cash flow. 2, many of you are on Xero. Whatever your accounting or reporting software, your forecast needs to be incorporated into or built in that software so that you can report actual results against your forecast every month. This enables you to recognize where you are against your targets. You'll learn how to become aware and comfortable with your cash flow cycles and how you can improve them. Having a cash flow forecast in place is one thing. Using that knowledge to change how your cash flows is another. To do that, you have to understand your cash conversion cycle and improve the business processes that can shorten it. 4, have somebody to encourage, support, and even nag you as you work on your business is the fastest and easiest way to get ahead in business. That person should be independent, not your spouse. Now I'm going to hand over to Rebecca, and she's going to go through the 7 key causes of poor cash flow.
Thanks, Julie. And I don't think I'm on mute, so that's great. So there are 7 key causes of poor cash flow. There's lots more causes, but these are definitely the top 7. So the first one is poor accounts receivable processes. So if you don't have the right process, this will often result in bigger debtor days. Accounts payable process, again, we need to review your supplier terms and identify any improvements in regard to cash flow that can be achieved by that. Carrying stock for too long means full shelves but an empty bank account. You need to review your debt and capital structures. Perhaps your debt should be consolidated and paid off over longer term. And maybe you need to have an honest look at the drawings that you take from the business. Or maybe that business needs to have an injection of capital to fund its growth. Often, significant cash flow and interest charge improvements can be achieved just with a regular review of the existing debt. Overview of your overheads. Every year you should review your overheads and compare them and see what needs to change. Low gross profit margins is another way of saying that your variable costs are just too high. And there are a number of strategies that we can go through to help improve those margins. Finally, sales levels just being too low to support overheads and other cash demands on the business. This comes down to how viable the business is right now. If the business is in a high growth mode and the sales are increasing rapidly, then the business needs to finance to support that growth, and we need to review that financing plan. If the business isn't in the growth mode, we need to focus on how we can grow those sales. So we'll look at all of these causes in slightly more depth. So the accounts receivable process. What can we do to shorten our cash conversion cycle by getting our clients to pay us faster? So there's a few things in here that we need to look at. First of all, your terms of trade. What sort of term do you offer your clients? What is the risk in there if they don't pay you on time? Do you charge them a late payment penalty? On the same side, do you offer them a prompt payment if they pay you sooner? If you're working on a project, do you only invoice your client at the completion of the project, or do you do interim billing? Maybe if you bill them in smaller chunks throughout the process of the project, you'll get paid faster. There are things like online invoicing. So Xero offers online invoicing, which makes it far easier for people to make payments. Do you take credit cards? Another option in order to get people to pay you faster. You can implement a Xero add-on as well that helps you to chase the money that's owing to you. So a couple of options like that is Debtor Daddy or Chaser. And what they do is they actually chase people in order to help them for you to get paid faster. The second one is accounts payable process. So what can we do to improve that process? So accounts payable, those are the bills that you have to pay. So to help with cash flow, do you pay your bills on time? If you pay your bills on time, then you won't incur late payment penalties. And we all know that IRD likes to charge late payment penalties for one. Does your suppliers offer you a prompt payment discount? So if you pay early, do you get a discount? And I know my courier company gives me a 15% discount if I pay on time. So do you have a spending budget in place? You know, maybe you need to review that budget and see if there's anything in there that you can tweak. Another way to shorten your cash cycle is to move your stock faster. So how can we do that? You need to review your stock ordering systems. When do you order your stock? Is there a way for you to order less stock but more frequently? And how do you manage that stock? Do you use some sort of process, some sort of technology where you track that stock? And when it reaches a certain level, that's when you order new stock. There's a few tweaks in there, and you also need to look at shrinkage controls. Hopefully you're not throwing too much stock away. When you look at your debt and your capital structures, how can we improve that? So when we're thinking about cash flow, we also need to be thinking about your interest rates. So if you've borrowed money, what's your interest rate? Is it a fixed interest rate? Is it variable? What's the term of that loan? And is that term right for your business? And you need to review your owner drawings. So this is the money that you take out of the business, and that money may be in addition to the salary that you receive. Do you need to consider a new investment? So do you need to borrow money or get some investment into the business in order to help with that cash flow? As part of your budgets, you need to every year review your overheads, and you might find that your overheads are too high, and by reducing them, that will help with your cash flow. So whenever I do it, I review everything annually, and that includes all of my suppliers. So my suppliers for all my IT services, my server costs, my phones, the website, the internet, insurance, power, all of it gets reviewed. I also look at my marketing spend and the return that I get on that marketing spend. And should I be looking at reducing my marketing spend or rearranging it in order to get a better supply on it? One thing we're doing is we're going paperless, which is a great way to decrease our overheads. Less paper, less stationery. If you do have staff and those staff have the ability to do expense claims, do you control that? Do you limit how much they can put through as an expense claim? You may just need to review your overall structure. Should you be outsourcing more? Can you eliminate contractors? All of those things can be considered to help reduce your overheads. What happens if your gross profit margins are too low? So the gross profit margin is what is left from the sales after deducting all your variable costs, such as the stock for resale, materials, labor. So things that you need to think about is, can you improve your systems and your efficiency to help increase that gross profit margin? Do you capture and bill all your time when you do a job? Can you talk to your suppliers, again looking at prompt payment discounts? How much work needs to be reworked, or is there any wastage in your organization? So for some businesses that buy materials, there may be some wastage at the end of the job. What happens to that wastage? Do you use it again? Can you sell it to somebody else? What happens to it? What happens if your sales levels are too low? There are probably hundreds of ways to increase your sales. But if we just look at 4 or 5 options. The first one is increase your customer retention rates. How can you retain your clients or your customers? How do you generate more leads? So again, going back to that marketing budget, How can you create more leads? How are you marketing? How are you advertising your services or your suppliers? Increase your conversion rates. So how many people do you talk to, but they don't become a customer or a client of yours? And how can you increase those conversions? You can increase the transaction frequency. So how many times does your customer or your client purchase off you? And is there a way to increase that? And the other way would be to try and increase the value of that transaction. So of course, the next question is, how can Julie and I help you with improving your cash flow? Every business is different, and what works for one business may not work for the other. So it is important to do a cash flow plan that's specific to everybody's business. And Julie and I, we can certainly help you all with that. We can help you with preparing a cash flow forecast, whether that's just for the bank or for yourselves. We can sit down, review your business and produce that for you. Or if you're interested on a more month-by-month basis, reviewing your cash flow, we can also help you with that. So what's our next steps? You have 4 possible courses of actions after today's webinar. You can do nothing. You can retreat, because I understand that this can be very scary and hard, and you might want to just go back to your business and just hide. You can take normal amounts of actions. So yes, you can think about doing a cash flow forecast, but you can do it yourself. That's not a problem. Or you can take a massive amount of action. So everybody's business is different. And of course, Julie and I, we're here to help you in any way that we can. So I'm going to open it up for questions. If anybody's got some questions, they can put a question into the Q&A box and we can answer them for you. Right, looks like nobody's got any questions, so hopefully we haven't bombarded you with too much information. But if you do have any questions after the webinar, you can always email Julie or myself and we'll be able to go through them with you personally. I'm just going to leave you with a parting thought though. The 3 most dreaded words in the English language are negative cash flow. So hopefully after today's webinar, you'll never hear these words again. Julie, did you have anything you wanted to add?
No, just thank you everyone for coming, and I hope you have all got something out of today's webinar, and we'll see you next time.
Perfect. We will see you guys again soon. Thank you very much. Have a good day.
Bye.
Bye.